Good afternoon, everyone. Thank you for joining us today for this webinar on RBI's latest master directions for strengthening fraud risk management and addressing willful defaulters. I am Javed and I am here with my colleagues Boishali Chakraborty and Soham Thakur, all of us lawyers at Lexplosion. We are looking forward for sharing our insights on these important directives. Before we begin, I want to mention this session was pre-recorded to avoid last-minute technical glitches. Later in the webinar, we will be joined by our esteemed panelist Shakshi Sharma, Chief Compliance Officer at Namdev Finvest Private Limited, and Sailesh Kasunur, Vice President Finance at Vista Financial Services Private Limited. They will actively participate in our live Q&A session, offering valuable insights from practical perspective on these directions. Please feel free to ask questions mentioning your email address in the chat box. We will do our best addressing them during the session if time permits. In this session, we will explore several key points such as the necessity of these new master directions, followed by the compliance requirements they entail, and we will also examine the role of technology in effectively implementing these mandates. On another note, I want to remind you that we have just 6 days until 31st of October 2024, which is the deadline for implementing the compliance monitoring systems for your organization, unless the timeline is extended further by RBI. In our previous webinar, we had discussed RBI's mandate for regulated entities for implementing compliance management system. For those who had missed the webinar, please connect with us. We will share our recording for the same.
A very good afternoon, everyone, and to Zaved and Boshali. I just wanted to add here one thing. That is, in addition to RBI's notification dated 31st of January 2024, the one that you were just talking about, Zaved, on 30th July of this year, RBI issued the master directions on treatment of willful and large defaulters, which is set to gain effect on 28th of October this month, which is just 4 days from now.
Yeah.
It will apply to selected regulated entities such as the commercial banks, cooperative banks, non-banking financial companies, including housing finance companies, as well as credit information companies. Further, RBI also issued three separate master directions on fraud risk management, which is applicable to commercial banks, including rural banks, cooperative banks, and non-banking financial companies, including housing finance companies. Now, these directions are already in effect since 15th of July this year. However, the early warning signal framework for NBFCs still has time till January of 2025 for implementation. It is something worth noting here that the early warning signal framework is already in place for banks, but it's a completely new requirement for NBFCs.
True. So we recognize that the implementation of these master directions presents significant challenges, including necessary system upgrades, policy revisions, employees training, and modifications to existing reporting mechanism. However, this transition also provides an opportunity for selected regulated entities to improve their operations, monitoring their compliances and their risk management practices. Without further ado, let us dive in RBI's directions on willful defaulters. Boshali, I will turn to you first. So my first question to you is like we know there was a master direction and a circular of 2015 on earlier occasion. What is your take on RBI's decision to repeal the same and introduce a new master direction?
Yes. So, first of all, good afternoon, everyone, and thank you, Zaved and Soham, for setting the context of today's session. Now, before I move on to your questions, Zaved, just wanted to add that the new master direction not only repeals the 2015 master circular, but also 60 other such circulars. The new master directions apply to banks and NBFCs and also states that NBFCs will have to now assess willful defaults for non-performing asset accounts with outstanding debts of rupees 25 lakh and above. Now, to address your questions, Aved, the primary goal of these directions is to establish a completely transparent and equitable process for classifying borrowers as willful defaulters. Now, this is very crucial for maintaining the integrity of our financial system. The directive also details measures and consequences for borrowers who deliberately default on their obligations. Further, the new directions also aim to enhance the financial ecosystem by identifying borrowers who intentionally default, which will improve the loan recovery rates, promote responsible borrowing, then it will assist regulated entities in making informed lending decisions, strengthen accountability within the sector, and finally, and most importantly, protect the investor interests to uphold the confidence in the financial system.
Thank you, Boshali, for succinctly outlining the objectives and the purposes of the master directions. This means RBI's intent is very much clear, that is to strengthen financial discipline and ensuring stability of financial system. Let us now discuss the significant changes brought in by the new master directions on willful defaulters.
Yes. So before we discuss the difference between the old and the new legislations, I just wanted to clarify what constitutes willful default and who qualifies as a willful defaulter. Now, in simple terms, if we look at it, a borrower is a defaulter if they fail to meet repayment obligations, and if this failure is intentional, they are classified as a willful defaulter. Now, as I mentioned earlier, according to the new master direction, any borrower or guarantor with a willful default involving an outstanding amount of rupees 25 lakhs or more can be considered for classification as a willful defaulter. Now, I'd like to highlight some key requirements in the directions. Earlier,
Vaishali, I'm sorry for cutting you short.
no problem,
Just
sure.
wanted to speak about one thing here before you go into the new aspects of the new master direction.
Yes.
And now the scope of applicability has been extended from only certain banks and all India financial institutions to all lenders. So it basically includes banks, NBFCs, including housing finance companies, credit information companies, and all India financial institutions like the NABARD, SIDBI, etc.
Yes, you're right. And including NBFCs in the 2024 master direction is something completely new that has been brought in. Also, in the earlier master circular, what we saw, Soham, is there were overlaps between the functionalities of the identification committee and the review committee. But now what we see is there are clear demarcations to ensure impartiality and transparency.
Absolutely, Vaishali. So, even for that matter, earlier there was no defined timeline for review and finalization of any borrower as a willful defaulter. But now the review and finalization needs to be done within 6 months from the date an account is classified as an NPA account and having an asset size outstanding debt of rupees 25 lakhs and above.
Yes, absolutely. And I think this would require quite a significant amount of modification in their existing processes, specifically for the NBFCs who are now required to implement this from scratch and to ensure that the timeline as specified by RBI is met. And it's to be noted that to meet this timeline, a periodic monitoring mechanism would be required and has to be set up in their processes to ensure timely compliance. Even for that matter, Soham, what we observe is the role of internal auditors have assumed a stricter mandate when looking into the willful defaulter classification instructions.
Absolutely, completely correct. And also the provision on publishing of photographs, especially of the willful defaulters, was optional earlier. While now all lenders will be required to formulate a board-approved policy for publishing the photographs of the willful defaulters.
Yes, so in a nutshell, setting up clearly demarcated committees and rupees 25 lakh threshold helps in targeting the significant cases of defaults. Regular reviews ensure the oversight. Publishing of photographs of the defaulters raise awareness but may also raise ethical concern. Overall, these measures create a solid strategy to reduce willful defaults. Thanks, Baishali and Soham, for the interesting insights. let's quickly review the key points of the regulated entities under the Master Direction of Fraud Risk Management of 2024. So we know that the Master Direction and the Master Circular on fraud monitoring was already in existence in 2015. What do you think led RBI to introduce the new 2024 Master Direction on the same subject?
Okay, so in recent years, Javed, regulated entities have grown and diversified significantly, especially with new financial products in digital lending and various kind of fintech collaborations. So this kind of made it absolutely necessary to update the earlier directions. Now, the 2024 Master Direction addresses these various kind of risks that come with these technological advances and the digitization of financial services.
Right. The financial landscape has become increasingly sophisticated with the rise in cybercrime and technology-enabled frauds. These new directions represents a shift from a reactive approach to a very proactive one. They aim to enhance fraud risk management in regulated entities, thereby helping them to prevent potential fraud incidents. The proactive strategy is therefore a key to safeguarding the interest of both the customers and the regulated entities. So, Swam, could you please share a brief overview of the key changes introduced in the new master directions compared to the previous one?
Sure, Javed. So the main change from the earlier directions is the shift in focus. While the previous master direction on monitoring frauds emphasized on establishing a reporting system for the various fraud incidents, now the new direction offers a much more comprehensive framework for regulated entities to detect early, prevent, and thereafter promptly report fraud to the law enforcement agencies, Reserve Bank of India, and other relevant regulatory bodies. It also aims to enhance the role of the board in overseeing fraud risk management. Additionally, the new direction stressed the importance of implementing a strong internal audit and controls framework within the regulated entities.
So, to summarize, the new direction enhances fraud management in regulated entities by shifting from a reactive reporting to a proactive prevention and early detection direction. It improves accountability at the board level, encourages thorough internal audit, and fosters a culture of vigilance, ultimately strengthening the integrity of the financial system. There are some significant changes from the earlier master directions. Bhushan, if you could throw some lights on them.
Yes, absolutely. So, if we review the compliance requirements from the Master Direction on Fraud Risks 2024, it can be categorized into three key areas. The first being governance. Now, under governance, the introduction of increased oversight role of the board is something which has been specifically made part of the new Master Directions on the fraud risk management. For example, the introduction of a risk management committee of the board is a completely new requirement for banks, while for the NBFCs, setting up of a special committee of the board for monitoring and follow-up of cases of fraud is a new requirement. The concept of natural justice has always been a guiding rule for all aspects of law. However, what we observe is the new master directions have been specifically baked with the principles of natural justice explicitly, and various steps and processes have been laid down in the statute which clearly upholds the principles in the way that the cases of fraud or the investigation of probable frauds are to be conducted.
So, if you've noted something, Vaishali, that the requirement to have a board-approved risk management policy is also something new for NBFCs and was not present in the earlier master direction.
Yes, and these new requirements definitely require NBFCs to prepare early and implement them effectively.
So, we can also quickly look at the process enhancements that has been brought in by these master directions. So, it's a crucial thing to have a clear system for issuing show cause notices and reviewing the responses to ensure that the right to be heard and impartiality while investigating cases of frauds or potential frauds is always met. Also, a mechanism for investigating whistleblower complaints according to the whistleblower policy is something new again for NBFCs. Finally, comes
Yes.
the monitoring requirements.
Yes, Soham.
Yes,
So,
Vaishali, if you can
sorry,
just
I would like
highlight
to
on that.
take this. Yes, I would like to take this from here. So, finally, if we look at the monitoring requirements, the regulated entities need to establish an early warning signal framework to monitor credit facilities and transactions. Now, this again is a completely new requirement for NBFCs, while for banks, this was already in place. It also has a catch here. This framework requirement does not apply to NBFCs in the base layer.
Correct. And this also brings in some major technological changes that would require implementation. For example, using of data analytics unit to track financial transactions, particularly those through digital platforms. Like also regulated entities on the reporting aspect must report the annual amount of fraud in their financial statements, report incidents to law enforcement agencies, and submit fraud management reports through the centralized information management system online portal.
Yes, and what we see is that's quite a lot of upcoming changes. I mean, I wanted to add that since implementing the early warning signals framework is new for NBFCs, this would require significant alterations in their existing systems and processes, like having proper methods of data collection to gather relevant financial and non-financial data from various sources, then identifying and selecting the most relevant data indicators through market research, and even the use of generative AI can accurately predict potential risks.
Even for that matter, Vaishali, integration of the early warning signals framework with the core banking system is something which is like now it's a statutory mandate as well. It's something which is very, very crucial to ensure seamless data flow and monitoring. Now, additional security checks would need to be amped up a lot because the early warning signals framework, which is generally a third party technology, would now be integrated with the core banking system. And ensuring security of this core banking system is very, very key to customer confidentiality and even soundness of the country's financial security. Like also to ensure this is constantly done, continuous updation of the system with new data and indicators would be required to adapt to the various changing market conditions.
So thanks, Soham and Boishari for addressing these important areas of the from the master directions. Let us now quickly introduce our esteemed speakers for the session today. Sakshi Sharma is the company secretary who brings over 13 plus years of experience in managing regulatory functions and currently serves as the chief compliance officer at Namdev Invest Private Limited. She excels in regulatory adherence, policy developments, and compliance trainings. Her impressive accomplishments include winning the Best Grievance Redressal Mechanism Award and the Best Compliance Initiative Award celebrated by NBFC Tomorrow and DNA Awards in 2023 and 24 respectively. Our another panelist, Shailesh Kasunur, is the Vice President, Finance at Vistar Financial Private Limited and is the chartered accountant with over 13 plus years experience in taxation, tax authority assessment, handling RBI inspections and investor relationships. He has excelled in financial plannings and analysis and due diligence ensuring legal compliances. Amongst his key achievements are the successful transitions to GST and Indian accounting standards as well as the automation of numerous processes.
Thank you so much, Javed. If we come to my first question for the session today, given the limited time for certain regulated entities to implement a compliance management solution after RBI's January 31st notification, what advice would you give to those still evaluating their options? So, Salish, if you could go first on this.
Yeah, sure. I think the as it is, if you look at the environment today, the way RBI is closely monitoring the NBFCs and also looking at various compliances, not only in letter but also in spirit. We also know the recent, RBI diktats on some of the NBFCs, etc. So uh, most, I think almost all the NBFCs, depending on their size, have some sort of a compliance management system. Either from a rudimentary point of view, it could be an Excel-based compliance management system. Somebody who has already transitioned to a cloud-based or a workflow-based compliance management system, they'll be having it. Uh, but I mean, we cannot stress further on the need to go ahead with a complaints management system, which is not just for the purpose of compliance with RBI's master direction, but it is also good for the NBFC. It's also good for the compliance team as well, because you're going to have everything hands-on once you move to a compliance management system. And therefore, for the whole ecosystem that way, if you keep the RBI compliance aside, just for the compliance team as such and for the company as well, to be in compliance with all the regulations that they are having. I think, and it's not just about, I think I have also said this earlier, there are so many compliances that have to be done that somebody has to make a repository of all these compliances, and then the next step comes whether you're complying with it or not, and then your verification whether you're uh, how are you dealing with those compliances. Now the first step itself is to make sure that all applicable compliances for the NBFC, from all, whether it is from the RBI or from whether it is a Companies Act or whether any other regulations, whether it is SEBI if you're having your either your equity shares or debentures listed, or any other regulations for that matter. To comply with all this, it's a whole set of regulations that are
Right.
very large in number from a volume perspective, and so it is very easy to miss out on a specific set of compliances either because of your uh, everybody is busy, and so if you have to just you need to have a strong mechanism to ensure you're tracking these compliances and then these are being followed. So when we talk of a compliance management system, I think it's not just about putting a tracker to your compliances, but also putting your whole ecosystem of whether as and when new compliances arrive from the regulator, you are able to track it, and then these are structurally given to different departments. There are owners to these compliances, and then these compliances form part of your regular processes. And this is where having a compliance management system comes into picture, because then you're not just relying on yourself or your own team or your network, but you have a professional vendor who is going to take responsibility of this, and then from notifying you on new compliances, providing you summaries, and then putting these compliances as part of your compliance process. Uh, it'll go a long way in making sure that your whole framework around compliances is kind of taken care of, from getting notified on new compliances up to compliance, from up to actual compliance, and the compliance team is also completely on top of it to make sure that one, all new compliances are being taken care of, and two, these are being complied within the organization in both letter and spirit. And therefore, considering the deadline that is coming in, I think if somebody has still not moved to uh, a decent compliance management system, I think it's time it should be taken. And I don't think it's like moving to a LOS or LMS. It's a much simpler, uh, adoption of technology. I think it's the right time to do it.
I'm like, thank you so much. That was very insightful and detailed, Sailesh. Sakshi, if you can if you can just have your thoughts on this as well.
Okay. So for regulated entities still evaluating compliance management solutions in response to RBI's January 31st notification, the key is to prioritize swift yet strategic action. So hence I approach that assess your immediate compliance gaps, opt for a scalable solutions like Lexplosion. So it provides timely updates and a complete tool for timely adherence, focusing on high risk areas that could lead to a significant regulatory issues, leverage automation and real-time reporting, plan for continuous training and updates, and making compliance an ongoing process rather than a one-time setup. So I think by focusing on these steps, entities can navigate compliance landscape more effectively even under tight timelines.
Thanks a lot, Sakshi. Vaishali, over to you.
Yes. So, thank you so much, both of you, for these insights. So, moving to you, Sailesh, what challenges do you foresee for regulated entities in implementing these two new master directions of 2024, which is the fraud risk management and the treatment of willful defaulters and large defaulters?
So I'll take up the first one, which is implementation of the early warning signals and identification of the fraudulent borrowers thing. See, one, if you look at the landscape today in NBFCs, there are NBFCs of various sizes, right? There are smaller NBFCs, there are mid-sized NBFCs like ours, there are big NBFCs like your Bajaj of the world. Uh, if you look at the risk management per se is not very evolved to my knowledge, because what companies look at today is more of a credit function and less of a risk function. When you talk of risk, you talk of operational risk, you talk of market risk, you talk of financial risk. You talk of a whole gamut of risks that need to be addressed. And when RBI talks of early warning signals to determine which of your borrowers, which segment of your borrowers could be potentially moving into a default category, it's kind of a big ask at this stage. I think it's the amount of work that needs to be done on this. I think is pretty huge. But having said that, I think we started off on the right footing in the sense that the RBI has now got a regulation to say that you need to have a system in place to put in risk metrics and to have early warning signals, which effectively means that companies start moving in that direction now. No, they have not said what, they have not defined, for example, say what are the ABC things that you should do, or what are the key analytics that you should have, which are reviewed by the risk committee or the audit committee or the board, which are considered as early warning signals. My guess is as we go along, these notifications and directions pertaining to risk management, overall risk management of a company will also evolve, and there will be more specific directions which will be given to NBFCs, wherein it becomes more standardized. For example, when we talk of NPA today, so everybody knows what an NPA is, right? It is 90 plus DPD or whatever is the new RBI set. It is very standardized. For an external investor, uh, when you talk this language, everybody understands the same thing. Okay. The same way, when tomorrow, if I mean, as and when as we keep this circular, by the way, is already kind of it's already applicable to NBFCs. Just that the early warning signals is applicable, say within 6 months, for that matter. So maybe by January or so, the company should have a system of early warning signals in place. So on the risk management, I think there's a long way to go for NBFCs, but it's a good starting point. I think that's what I would say, and it's good for external investors because they'll have confidence that the regulator has pushed for a risk management system, and this risk management system over a period of time uh, will be implemented across NBFCs. But if you look at the fraud, identification of willful defaulters, this again, it is a huge thing, right? For example, identifying a willful defaulter for a corporate client, okay, is very different from identifying a willful credit card defaulter, for example.
Right.
Why? Because the ticket sizes are very different. A corporate borrower is 100 crore, 200 crore exposure. You have a team analyzing his numbers every now and then you can determine and decide whether he's a willful defaulter or he's not a willful defaulter.
Yeah.
So how are you going to deal with identifying a willful defaulter where your average ticket size for a loan is say 5 lakh, 2 lakh, okay, or a 10 lakh, where you have thousands and lakhs of customers.
Hmm.
So if your internal audit system or any particular system within the organization has to identify that there is a fraud, and you have to give a sufficient notice, and you have to follow the process of natural justice that they have mentioned in the notification. And then after that, you are going to identify one particular borrower or a set of borrowers as willful defaulters. You can just imagine the scale of work that you have to do to make sure you're able to identify somebody as a willful defaulter, and not just identify but also report to the authorities, because no authorities, if you go to the local police station, I mean, for all good reasons, they will not even take your FIR. That is the reality, because he will say he will stand on the side of the customer and not on your side, correct? So it's a Herculean task to be able to do this. But yes, I think the directions are in the right direction, if I were to use the term. And I think along the way, I think we'll find that the level of risk management in NBFCs is only going to increase. The quality of risk management will increase thanks to these directions and RBI's push in this direction, and it will help the overall ecosystem.
Sure. Thank you.
So my next question will be for Shakshi. So Shakshi, the master direction on willful defaulters has been a new concept in the life of an NBFC. Considering there were no previous regulation on this for an NBFC, how have you been monitoring willful defaults in your current situation or processes, and what adjustment will you need to do to make to comply with the new directions?
Okay. So before the introduction of the treatment of willful defaulter master direction for NBFC, so our approach to monitoring willful defaults was primarily centered around internal controls, intelligent credit assessment, and regular monitoring of borrower accounts. And we relied on detailed due diligence during the loan approval process and the periodic reviews of prepayment performance to detect any sign of financial stress or defaults. So
Understood.
additionally, our existing fraud risk management framework included measures to identify potential cases of frauds or misrepresentation that help us managing defaults proactively. And with the new directives, we will need to make certain adjustment, means not such kind of adjustment to ensure full compliance. So this includes formalizing our process for identifying and classifying willful defaulters as per defined criteria, implementing strict reporting requirements, and ensuring that appropriate actions such as legal proceedings, restricting further credit facilities are taken in
Right.
timely manner. And we will also need to establish a dedicated grievance redressal mechanism for borrower classified as willful defaulters. So, and as well as ensure alignment with the RBI's reporting and data submission standards with all four CICs. So, I think
Yes.
these changes will enhance our monitoring capabilities and bring our practice in line with the latest regulatory expectations.
True. True. So what I can understand is that the process of identifying a willful default was there by default. It was a process already in your system. Now that the new master direction has come into play, like you have to make certain, like as you said, you have to make certain adjustment or certain things to comply with the directions, right?
Yeah.
Understood. So Shailesh, do you have any thoughts on this?
No, yeah, no. What was said is right, and what you said also is correct. To say that you know, internal audit system is your
Yeah.
first line of, not your first line, so your
Control.
third line of defense, right? So first is your management and your own processes, correct?
Yeah.
So already, for example, you already have an internal audit system. Probably the NBFCs, many NBFCs have moved to a risk-based audit and not just a regular internal audit. When you say risk-based audit, then it has some triggers which say that, okay, if X, Y, Z happens, or these are the triggers for me to identify where I need to go and put in my resources for audit. Now, if you have done all of these things, there's a possibility that you have also identified a fraud, correct?
Yes.
So
Yes.
it is part of an existing system, and RBI already has FMR reporting that is
Yes.
required,
Yes. 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 Yes.
and which also has definitive timelines and how you need to do a quarterly reporting
Correct.
and all of
Yeah.
that. So
True.
identifying fraud is not the question here, because identifying fraud as it is happening, but identifying a willful defaulter
Yes.
is a second leg to the same thing. To say, how are you going to identify somebody as a willful defaulter, and what is the difference between a fraud and a willful defaulter?
Sure. Sure. So, Soham, Roshal, you can proceed to your next questions to.
Yes. Thanks, Avid. So, Sailesh, I just want to come to you again on one aspect of this. Is that what would your views be on how the new directions regarding the willful defaulters will affect the borrowers and their repayment behavior?
So see, on the borrowers, again, it again depends on a segment of borrowers, right? So if it is your
Yes.
corporate borrower, then there's a name and shame thing that happens. So you're calling somebody a willful defaulter, it becomes difficult for them to get a loan.
Correct.
But if it is your retail borrower, which most NBFCs cater to, who have an average ticket size of say 2 lakhs to say 50 lakhs, 1 crore, whatever. So here, I think one thing is definitely once, see, for example, while what we were speaking earlier was on identification of frauds. When you identify a fraud in a particular market, and then you're also able to file an FIR against that person, and you're also able to put in collection mechanisms such that you're able to recover if it's a secured loan, their property. If it's an unsecured loan, still you're able to recover based on whatever legal actions that you have taken. Automatically, in that particular customer segment or in that particular customer geography, already people know about it. That if you're going to do
Right.
a fraud like this, then this is what is going to happen. Now, having a regulation around it gives you a strength from a regulation point of view to say that one, you have legal options. Two, your regulator is also behind you to say that boss, you go ahead and take what legal actions you need to take. You also identify willful defaulters. I will enhance this process even further by making it more formal. So obviously, I mean,
Absolutely.
this whole process is going to help better the customer behavior definitely, but it's all about execution. I mean, while we have a regulation in place, how effective it is going to be in being able to implement it at the ground level would be something that we'll have to see. Whether it becomes because your state police, your other law functionaries are different from your
Yes.
RBI, and RBI will not have for example, say a say on what happens on the ground on how those officials take a call. For example, I mean this is just an example. They will not have for example, if you identify something as a fraud and you need to go through the court process for recovery. No, RBI will not get into all of that, right? Now, as far as RBI is concerned, yeah, you're going to put it in a repository. And once you're going to put it in a repository, then it helps because then we have access to a repository which says, when you're not going to lend to these set of people because these have been identified as willful defaulters.
Right. Right.
Again, it's a very good step for the industry as a whole because it's going to help
Yes.
NBFCs identify defaulters much before at the time of lending.
Sure.
Right. And specifically on this, even the board approved policy that now is required for like photo publishing of photographs of willful defaulters is something which is absolutely in line with what you've been saying, Sailesh. Yeah. Vaishali, over to you.
Yeah. So this part of my question is more on the early warning signal framework, which I think Sailesh initially he captured elaborately in detail. So I'll go to Sakshi for her thoughts on, I mean, having experience in this particular sector for so many years, and specifically this requirement of early warning signal framework comes for NBFCs, as a new requirement under the new master directions. So we want your insights on how it can help in identifying potential fraud and how it is going to help in your system of monitoring them.
So the
Sakshi, over to you.
basic So basically, the early warning signals means EWS framework plays a crucial role in detecting potential frauds by identifying early signs of financial stress or suspicious activities on borrower accounts. So it involves monitoring various indicators such as sudden changes in account activity, financial performance, or payment patterns, which may signals fraudulent behavior of customers. So, by providing timely alerts, the EWS frameworks enable lenders to investigate and take preventive measures before the situation worsens. So I think this proactive approach helps in mitigating risk, reducing losses, and
Mhm.
strengthening the overall fraud risk management process, thereby enhancing financial stability.
Right.
Got it. So this is more from the perspective of the early detection of the fraud, where you can
Ye-
identify it and then go ahead and ensure the prevention and mitigation aspect as well. So that, I think that is really important for the sector. So over to you, Zaved, for the
Yeah.
next
And
topic. Yeah.
just before coming to my next question, like one more thing what I can understand and while reading these two directions as well, what we internally discuss is there is a interlinkage between these two directions. I think that there is a direct connectivity between these two. One is willful defaulter, one is on the fraud monitoring, so they are linked, right? So if you can put some practical examples or your thoughts on them, that will be very good for us. Like Shailesh, you can take the question, or Sakshi, any one of you. What do you think? Is there is a direct linkage between these two directions?
Of course, see. So, what is an early warning signal? Early warning signal is that something is going wrong, you don't know where. So, you're going to
Yeah,
look at some of these metrics, either qualitative or quantitative, to determine, where to look and what to look. Correct? That's your early warning signal. Correct.
sure.
Now, if so, early warning signal is going to give you send you in the direction. Where to look, which pool of
Yes,
assets do you need to look at, where there is a, like what Sakshi was mentioning, where there is a suspicious activity in specific accounts and things like that. Once you go there, then it's a process of identifying. Now the directions also say that the outcome, what should be the outcome of your EWS? The outcome of your EWS is, are you changing your credit process? Are you changing your sanctioning process? Have you detected a fraudulent activity as part of your EWS? If yes, do you want to get it verified by internal or an external audit? And
right,
this has to be form part of your board approved policy, and therefore obviously
right,
these two are linked.
right. So, Sakshi, do you want to add anything further to what Shailesh stated?
No.
Okay. So my next question to you, Sakshi, is like how do you think the regulated entities should strengthen their internal audit and controlling frameworks to align with both these master directions?
Okay. To align with master direction on fraud risk management and the list of
Both.
willful
Yeah.
defaulters, so regulated entities should consider the following strategies to enhance their internal audit and control frameworks. So first
Okay.
is risk assessment and mapping, robust internal control, continuous monitoring, training and awareness, enhanced credit processes, collaboration with stakeholders, reporting mechanism, regular review and updates. So I think by adopting these strategies, regulated entities can significantly strengthen their internal audit and control frameworks. And ensuring alignment with the master direction on fraud risk and the list of willful defaulters, enhancing their overall resilience against fraud.
Understood. Understood. Appreciated. And Shailesh, do you have anything to say on this?
No, that was exhaustive. What
Yeah.
Sakshi just mentioned, I think that kind of covers everything. Yeah.
Okay, I just wanted to quickly mention that we'll have time to discuss just one more question, and then we'll move on to a live Q&A session for addressing some of the questions from the viewers. Vaishali, over to you.
Yes, thanks. So my last question, which I mean, it continues to what Sakshi was mentioning, is with respect to the collaboration to ensure that the best practices are followed in the sector. So, how important is employee training and awareness in preventing willful default and fraud in an organization?
So, employee training and awareness are critical components in preventing willful defaults and frauds within an organization. And well-informed employees are better equipped to recognize suspicious activities, adhere to compliance standards, and report potential issues proactively. So the significance of training and awareness can be summarized like early detection, cultural shift where employees feel responsible for upholding organizational values and are less likely to engage on or overlook fraudulent activities, compliance adherence, empowerment and accountability, like empower them to take ownership of their roles in risk management and encourage a proactive approach to report concerns. Best practices for training and awareness, interactive learning, real cases studies,
Yes.
feedback mechanisms. So I think by prioritizing employee training and awareness, organization can significantly enhance their defenses against willful defaults and fraud, leading to more secure and compliant operational environment.
Yes, I think, and that is very important because it is, as I said, it's a collaborative approach. So it is the sector and the people in the sector who are working in it can help reduce these risks for their sector and develop a better and a safer financial ecosystem for our consumers and customers, and of course the investors. So with this, I end my portion of questions. Away, over
I
to
think
you.
I think Shailesh also wanted to say something on this question.
Okay,
So
sure,
it's like
sure.
Shailesh, if you want to add something, please go ahead.
No, no, I think that was covered in detail. But I think broadly, if you were to put one or two points, one biggest training that needs to be given to a employee on the field who is interacting with the customer, who has a face time with the customer, is risk awareness. One is risk awareness, and the outcome or the impact of taking a incorrect decision or taking a shortcut, if you want to call it, to either to meet targets or to do incorrect lending or to follow incorrect practices on the ground. So they need to be aware. There needs to be a disciplinary mechanism. They need to be aware, what the regulation is. See, typically the employee knows what is right and what is wrong, right? And what is right and wrong is what is there in the regulation. So ultimately, you should know the consequences of taking a wrong decision, and the consequence has to be swift and it has to be taken at the
Right.
appropriate time. Therefore, the messaging at the ground is very clear, saying that what is acceptable and what is not acceptable behavior. One is an employee fraud. The second is a fraud by the customer, for example. Fraud by the customer is more difficult for an employee to understand, and that's where what Sakshi was mentioning as training and all is required. Because then
Right.
you are going to
Right.
train your employees based on your experience over the last many years dealing with different types of customers. So the credit team may train their credit manager saying, okay, this is what you need to look at. This is the type of questioning that you need to do to kind of identify a serious customer versus a fraudulent customer.
True.
And that is a process that it's a continuous learning process, and the trainings have to be continuously updated such that all the learnings from the ground are shared with all the employees, such that the culture of risk is kind of maintained. It's not just the culture of meeting your targets, but it's also the culture of risk, so that you have a balanced growth.
Sure, sure. Point taken. So, thank you so very much, Sakshi and Shailesh, for the wonderful insights and the and sharing your practical suggestions on implementing these directions. We have, however, overshot our time a little bit, but the insights that we received today were really interesting and surely will help us and our viewers as well. We will be able to take just a couple of questions today before we end our session. Thanks a lot. So, one question which we have received is like, Shakshi, if you may answer this, like, why has RBI excluded NBFCs in the base layers, setting up an EWS framework? So, NBFCs in the base layer are not required to set up EWS. Why? So, this is the question, Shakshi, if you could respond.
So, As per my understanding, RBI initially implemented the early warning signals monitoring framework for banks and has now extended it for NBFC in upper layer, middle layer, as well as base layer NBFC with an asset size of rupees 500 crore and above. So, this extension reflects the regulator intent to strengthen fraud risk management across larger and more complex financial institutions. So, however, NBFC in the base layer with a smaller asset size are excluded as their simpler operation and lower risk profile do not necessitate the same level of monitoring. So, by targeting higher risk entities, RBI aim to ensure an appropriate balance between regulatory oversight and the operational capabilities of different categories of NBFC, I think.
True, true. So, Shailesh, do you have anything to add to this question, or else I can move to the next question to you directly?
Yeah, we can move to the next question. I think
Okay.
the answer was what Sakshi mentioned was kind of uh, to the point to say.
Yes,
Thank you.
absolutely. Absolutely. So the next question is, in case of suspected frauds, like how should regulated entities decide between using external versus internal audit for investigation? What factors should influence this decision?
Okay, so if I can take that question.
Yes,
Uh,
Shailesh.
so see, I think fraud can happen at various scales and various levels in the organization, right? It can be at the field level, it can be at the mid manager level, it can be at the senior level,
Yeah.
and the complexity of the fraud. So one is the scale of the fraud, one is the complexity of the fraud, and the third is at what level has the fraud happened. At a more senior level, and the fourth is also what is the competence of the internal team to uh, review that fraud and get to a conclusion on the fraud, depending on the complexity of the case. I think these are the four factors. Broadly, if you look at it, if it is a slightly the scale is very large and you do not have the resources to do it, then you go to an external auditor. If the level at which you believe the fraud has happened is at a slightly senior level, and you believe the internal resources might find it conflicting to approach the senior folks and then do a fraud, then the board may recommend for an effective investigation that an external agency do it. Similarly, the complexity of the fraud and the more complex the fraud, maybe you may want to involve external agency who has expertise in say technology and cyber fraud and things like that. And same way with respect to the competence of the internal team, what are the resources available within the company, and uh, uh, what are the resources available, and how far can you stretch to make sure the investigation is time bound and you're able to be fair and transparent. I think these are the various factors that would decide, whether you want to keep it internal, external, uh, along with what your board approved policy says as well. So you also have a board policy, and how you have framed your policy would also determine what goes internally and what goes externally.
True. True. Thank you, Shailesh, for sharing your insight and being practical about your answer. So it was very practical. And so Sakshi, I'm going to you with the next question. It is like, is there any reason for monitoring only those NP accounts with outstanding debt of rupees 25 lakh and above, and not for the ones below the threshold? So there was a question from the audience as well regarding in similar lines. So we have received two questions. So I'm reading one question verbatim. Is there any reason for monitoring only those NP accounts with outstanding debt of rupees 25 lakh and above, but not for the ones below the threshold?
So I think the rationale for monitoring NP accounts with an outstanding debt of rupees 25 lakhs and above is to focus regulatory efforts on cases that pose a higher risk to the financial system. The larger default have a more significant impact on the stability of financial institution and the overall credit market, making it essential to closely monitor and address these accounts. So by setting this threshold, the RBI ensured that resources are utilized efficiently, concentrating on higher value accounts where the potential for recovery and risk mitigation is more substantial. Smaller NP accounts, while still important, may not individually represent a significant threat to the institution's stability. And monitoring each one with the same intensity could dilute the effectiveness of fraud detection efforts. The threshold helps prioritize cases that could cause greater financial harm, allowing institutions to manage their resources more effectively while still addressing risk across their portfolios.
Sure, sure. Thank you, Sakshi, for your response. So we have 5 more minutes left. It's basically 4 minutes. So Boishali and Swam, I think we have been receiving few more questions as well. So let's carry forward with those questions as well.
Sure, Javed. So, what I wanted to quickly come up with to Sakshi, if I may, there's one question that we received is how to prove that customer is able to pay but not willing to pay. We can check CIBIL, but customer is not reachable and defaulted and non-cooperating.
Yes.
So, if there is any thing that you might want to share here, Sakshi.
Uh, to assess a customer's intention in case of potential default or suspected fraud, a financial institution can use a combination of approaches like analyze payment behavior, examine communication patterns, evaluate financial positions, investigate uses of funds or asset diversion or sale, background and reference check, legal action or multiple defaults. So I think by
Right.
combining these methods can help determine whether a customer default is intentional or due to genuine financial distress.
Understood.
Thank you,
Understood.
thank you.
So
Thanks,
I think
Sakshi.
we will go ahead with one more question. Boishali have a question for
Yes,
Shailesh.
yes,
So
yes,
Boishali,
I
if you
do.
may, yes.
Yes, Anish. So this one is with respect to the fraud master direction. So the question states with respect to the fraud master direction for the assets that are sold to an asset reconstruction company, the responsibility for reporting to RBI is now with the seller, that is the NBFC. What should be the process for taking that up?
I think they have specifically mentioned in the direction that when you sell something to an NBFC, you need to report and also you need to hand over, you need to inform to the ARC as to what actions have already been taken in terms of the directions. And beyond that, I think the ARC is supposed to also their website or they are supposed to report to the CICs as to what is the status of these willful defaulters on a quarter-on-quarter basis or month-on-month basis. What is the outstanding, what is the repayment, and what is the status. So I think the responsibility is on both the sides. It's not just on only on the NBFCs, to my understanding and reading of the notifications.
Right. Right. So we think we will wrap up the session now. Thank you so much. Thank you, Shailesh. Thank you, Sakshi, Vaishali, Swan, all the audiences and viewers. Thanks so much for being patient and listening to us for last 1 hour. And this has been an insightful webinar session from the perspective of the subject which we discussed. Thank you so much. So we are ending the sessions. And for those like there might be few questions which we have skipped or not answered. We will try and answer them or reach out to you through emails and respond to those questions at the earliest. Thank you so much for your time and patience.
Thank you.
Thank you.
Thank
Sure,
you.
thank you very much.
Thank you.